Today, we're back, but it's the same old, same old. Again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. I'm joined by Tarric Brooker today. Hi, Tarric.
G'day, Martin. It's great to be here. It's been a while.
Great to be back on. It's a couple of months since we did our last show. I must say I've missed them, and I think our audience has too.
Yeah, me too, mate. I always enjoy, sitting down at the, on a Friday, just chilling out and just talking shop with you. And it's, it's always good to just, bounce some ideas around. And boy, have we missed a lot.
Well, I was going to say we have, and yet we haven't, right? Because it's still the same old in so many ways. Migration's going up. Inflation is still raging much more strongly than people expected. People are now thinking the RBA may have to put rates up higher, et cetera, et cetera. We aren't building enough houses. Rentals are still up. Wherever you look, it feels like, oh, how much has changed? A lot's changed, but nothing's changed.
Yeah, I guess it just depends on it's not on perspective, because in the US you've got the banking crisis, which is occurred a few days after we went off the air. So
we created it, right?
yeah, obviously, they were just like, well, Martin's moving this week, and so we'll just pencil that in for then.
And I did a show actually on the regional banking crisis yesterday because. About a month ago, there was a report saying something like 180 regional banks in the US are potentially exposed to the same pressures because of the rate rises and everything else, right? And of course, we've had First Republic and we've had a couple of others. But a lot of people are sort of saying, oh, no, nothing to see here. But it seems to me that it's getting to the pointy end of this now. And I suspect we're going to see a few more banks also getting into difficulty.
I think you're right. I think we're going to see more problems. I think we're going to see more banks fall over, but I think it's going to occur over a rather long-term sort of thing. You're going to see, the FDIC, which is the Federal Deposit Insurance, and the Fed and the Treasury step in when needed. But I think it's going to be quite targeted. There was headlines earlier today. That basically the Treasury and the Fed are just like, well, we don't really want to touch First Republic right now. We just want to let it play out organically for as long as we can. And I think that's sort of the message, and this is something that you and I have talked about before, that sort of burnout economics where you've got the different forces pushing and pulling in different directions. And in this instance, it's just that them doing as little as humanly possible to try and, in some ways, to a little bit sneakily, put down a little bit of extra downward pressure on inflation through tighter bank credit.
Yeah, well, it is the tighter credit, which is the real story, right? It's fascinating to watch this as a time when credit card debt in the US is rising, where more people are actually exhausting their savings and are having to turn to credit. And it's at the very point where the banks are actually tightening the throttle back because, well, they don't have the capacity to lend as quickly and as freely.
No, we are seeing that pullback in lending, not to the degree that perhaps some of the sort of more downside scenarios we're exploring back in March, when everyone was running around with their hair on fire saying that rates are going to be cut basically imminently. And, it's worth noting that was, the broader market. That wasn't just a few people, on the fringes, that people were talking about rate cuts in June, which now people are talking about rate rises in June. So that's all changed quite significantly. And, it's going to be interesting to watch. I think it's going to play out over quite a long time, but I think that this sort of feeds into my sort of central thesis, which is basically things are going to hold up for just long enough for it to turn into a real calamity, rather than just having a more normal recession, either at the start of the year or right now.
I think the slow grind is where I am as well. That if you look at the leading indicators, that a lot of them are actually signaling significant issues, but not enough to stop the Fed from doing what the Fed is still going to probably do, which is to put rates up higher. And the inflation battle, you look at the data Australian inflation, UK inflation, or US inflation. It has become more embedded. It's still linked very much to services and wages. And whilst they've had some relief, because of course some energy prices have come down from their peaks, other categories of inflation are actually now really running away very strongly. Food inflation, for example, is still very strong. So this isn't going to play out quickly. And I think that a lot of the markets are still fooling themselves if they think we're going to see rate cuts by the end of this year.
Yeah, I saw. Did you see the little? I'd probably call it a rant. I think a rant is the correct word from Christopher Joy today on Twitter.
I read it briefly. Yes, I did.
Yeah, basically he was saying that that he thinks all this talk of rate cuts and everything else is premature, but he thinks that central banks are going to largely stay the course for at least the time being. And it wasn't quite as diplomatic as that, but but to be honest, I broadly speaking, I agree with him. I think we're going to see most central banks stay the course. I think we're going to see the Fed stay the course, and they're going to probably try and drag the likes of the RBA along with them. But I'm increasingly skeptical that the RBA are going to actually do their job.
Well, have they been doing their job for the last year plus? I mean, look at the RBA review that came out. Was pretty damning, actually. But the conclusion was, well, they probably didn't do the right things at the right time. But I have to say the recommendations were horribly weak, and I'm fascinated by the fact that the government doesn't want to have anything to do with monetary policy. So basically, they want to disengage themselves from effectively potentially being able to interfere or interject if they don't like monetary policy. It's fascinating that those who are elected walk away. Those unelected, those central bankers who are basically paid a lot of money, well, to do I'm not quite sure what, have no accountability, no responsibility, and nobody wants to hold them to account at all.
Well, that's actually a question that we got from a viewer. So shall we start to get into the questions?
Great idea.
Okay. Where was it? Mitch asks, the impact of Labor's changes to the RBA, will it mean less independent decisions on interest rates and less independence overall? What do you think?
Well, what they're saying is they're going to change it so they're basically two objectives rather than sort of two and a bit objectives, right? But very importantly, the Treasurer will not have any ability to be able to override monetary policy or even, change monetary policy, which essentially in theory means the RBA becomes even more, quote, independent, unquote. But of course, the review basically recommended less frequent meetings, more communication, including press conferences, etc. And I'll just remind everybody that the other central banks around the world have been already playing that playbook for the last 2 or 3 years. So the RBA is way off. But the idea that somehow the central bank knows best and, they're going to do the right thing, and so politicians back off even more, that really worries me. Where's the accountability?
Yeah, I tend to agree. I mean, I think more independent decision making is possible, but to what degree that is actually going to be the case is another matter. And something that really disappointed me about the review is some of us with, shall we say, contacts who are well connected know exactly what's been going on behind the scenes at the RBA. I can't get into it without getting horribly sued, but suffice to say, that there is a lot more in need of review than has come up publicly, and I think that is just a joke. Because if there are these big issues that people that well-connected people have heard about, and people at the RBA have experienced repeatedly over years, perhaps the public has a right to know about those things rather than them just being swept under the rug. And and then you just see people exiting rather than the debates that need to be had.
Yeah, I mean, the point is that the true debates that should be being had probably aren't being had. And of course, Phil Lowe, after the review came out, said, well, it's not been my experience, et cetera, et cetera. So the whole question of the relationship between the board and, Lowe and the rest of the people. But the point is, a lot of the work that is done within the RBA doesn't necessarily seem to inform the decisions. And in some cases, for example, the forward guidance, no interest rate rises for 3 years in the report said, well, actually, that wasn't in any way discussed or explored beforehand. It was pretty much made up on the spot.
Yeah, the RBA's communication is awful. If there is any takeaway from all this, it is absolutely abysmal. It is up there with probably the worst in the world. I
Yep.
mean, they may as well be the Bank of Turkey for how badly they manage their communications. And the thing is, like, there are times when Powell gets up there, he'll do a press conference, he'll say something during, usually not during his prepared remarks, but usually during a question, and he'll misframe something, or he won't frame something incorrectly as to, the party line of the Fed. And then the market will run away with it, and you'll see, the market rise, and there'll be all these headlines. But then the next day or the day after, Powell or someone else will come out and correct that mistake. Now, when Lowe said no rate rises till 2024, they let the media run with that. Yep. There was headlines, day after day after day after day, and they can say, "Oh, that wasn't our intention," and all these equivocations as much as they like, but it's their responsibility to make sure that the right message gets through in the end.
Well, that's right, and of course they were slow to take rates up. They took them too far down, and then they left them there for too long. The term funding facility was a joke; should never have been done. Wherever you look, you'd have to say, I give them a very poor report card. And interesting, I don't really notice this, but the data that came out today, the end of month data, they've suddenly made some changes to the reporting in the statistics. So effectively, there's now a sort of an interesting series break, which makes it quite hard to track long-term trends in terms of credit growth.
This is my surprise face. It's not really. I mean, I to be completely honest with you, like me and the RBA don't get along. And it's the one-sided thing. I mean, I'm more than happy to talk to anyone. I mean, I've had my issues with other people in the past. We're more than happy to have a completely fine working professional relationship, but they just don't want to play ball. But we should probably get into more of the questions before this turns into another rant. Liam asks, Christopher Joy said there's a 50-50 chance of another interest rate hiking cycle that has not been priced in by the markets. Do you believe it's likely? And if so, to what degree?
I think rates are going to go higher. And to that extent, the fact that there's a pause and then more hikes, you can argue that it's another sort of upcycle that people weren't expecting. The markets are still mispricing, in my view. And if you look today, the ASX 30 is still thinking rates are going to go quite a lot lower. But I don't think that's real. I think that we are going to see rates having to go higher. Lowe the other day did say that, we'll wait for the data, but inflation has to be crushed. And there's no prospect at the moment that inflation is going to be crushed in the next couple of years.
Yeah, I tend to agree. I mean, I don't understand the celebrations for this week of the inflation data. It doesn't make any sense to me at all. But
well, basically, transportation costs have dropped because all of the high price flights over the summer got discounted again, right? So that's why those prices came down. Whereas food prices, energy, and others went higher. And of course, the energy price shock for Australians are still to come.
Yeah, it is still to come. And this is something that I've discussed with economists from overseas, analysts, economists, you name it, from the US, from Europe. And they just and they say, like, and I talk to them and they go, okay, I've looked at the partials. This is what's going on with your rental sector.
Yeah.
Unlike the US, you guys haven't even seen anywhere near peak rent, peak rents, which is likely to contribute somewhere between 0.5 and 0.7%, annually to headline inflation. And it's just like that by itself is like, 1/6 of the RBA's entire target alone. And that's before we get into everything else. And I think that realistically, inflation has just been so suppressed for so long, by technology, by China, by all these different things, that people are really having a hard time wrapping their head around the fact that even just removing some of those forces slightly and adding in some baked-in inflation in the form of, say, energy bills and rents, which is something that pretty much everyone, who's been paying attention has been warning about, it's going to be pretty hard to get inflation sustainably back under 3%. I mean, I think it can happen if we do see like, you know, a global recession or an energy price, you know, like the bottom just falls out like in 2008. But that doesn't necessarily mean it's going to be sustainably back in the target range for good.
No, interesting. I don't know whether you saw Hugh Pill, who's the economist for the Bank of England,
Yes.
in a podcast, made a very interesting observation, which was basically people have got to actually accept that their standard of living is going to go backwards, and they've got to actually deal with it, rather than actually claim higher wage rises to try and keep up, or indeed corporates putting their prices up. A very interesting observation. Of course, the real thing that he didn't talk about was the root cause of the inflationary pressure, which was ultra low interest rates, quantitative easing, and flooding the money supply.
Yeah, well, they don't talk about that part, though, do they? You know, it's just it kind of astounds me in a way, because, you know, like you look at these various things into inflation, you know, into, you know, investigations into why we have inflation. I mean, okay, you know, some people will just say, well, it's bloody obvious, but, you know, looking at it from, you know, their little, you know, perspective. On one hand, you know, you see the politicians blaming the central banks, and on the other side of things, you see the central banks very tentatively and very carefully placing blame on fiscal policymakers.
Yep.
But the truth is as you say, they're both responsible, and because they're both responsible, no one's being held responsible.
Yeah,
and I don't think that the lessons are going to be learned that are going to prevent this from all happening again.
No, I agree. Everyone is blaming everybody else, and they're all finding excuses and reasons why it wasn't them. So there's plenty of blame to go around, but nobody wants to take accountability. And you know, I lived through the high inflation a few decades back, and it's painful, but it's also long. This doesn't get fixed quickly, and I don't think there's any chance of getting inflation fixed quickly.
So you think even if we have like a really challenging recession, it's just going to be back. We're going to be back not quite back where we started, but we're still going to have an inflation problem, say like 12, 18, 24 months after a recession.
I think that it's likely to be a lot longer than people think, and I suspect it's going to be much more painful and much more difficult. Of course, those who are in the affluent set will be able to live through it, sell through it, no problem. But the bulk of businesses and the bulk of ordinary people are going to find it really, really challenging. And you know, I said a few weeks ago, the bad news is not in the past. There's more bad news to come, and I'm expecting considerable pressures on ordinary households. And in fact, today, Roy Morgan published their latest mortgage stress data, which was up again. I'll be publishing mine in the next few days, which is up again. And we're already seeing on the ground floor in real land, really people already finding it very difficult. And they're changing their shopping behaviors, for example. You know, they're going into discount land rather than not, and buying different types of products and all sorts of things like that. Happening in the UK, it's happening in the US, it's happening in Australia. These are structural things that are going to take a long time to work through. Like I say, all the bad news is not behind us. I think there's going to be more bad news ahead.
Well, I mean, even if we take say, for example, the RBA's forecasts at face value, which is always a mistake, but let's say that they're correct somehow, that wages growth accelerates, that inflation comes down relatively swiftly. That is still, in net terms, more pain for Australian households. It's less spending power. It's more spending power having to be dedicated to the basics. And I think that is really the underappreciated story in the entire inflation debate, because that has done more damage than rising rates will ever do in the long term. You know, I put together an analysis recently of how different demographics are faring in terms of where their household purchasing power is. For people aged 20 to 24, their household purchasing power is about 2002 levels.
Yep.
For people who are at 25 to 34, their household purchasing power is somewhere around about 2004, 2005 levels. Now, it's a better story for people who are in the older age groups, you know, the 45 to 54 and 54 to 65, but still their wages are at sort of 2013, 2014 levels. So they've still lost all these years and years of purchasing power. And as you say, there's still the other challenging parts to come as well, which are going to worsen that picture. And I think that it concerns me a great deal because it leaves the economy even more reliant on credit growth and equity, mate, because the traditional driver of the economy, which is households earn more in real terms, households spend more in real terms, and the economy grows. And that's just the way it normally works and has worked since forever. But now it's just all about equity, mate, and it's all about, these households on these massive war chests of cash. It's not really looking like a terribly fair future or a terribly balanced one for the populace.
No, and then if you add in the high migration, which of course is happening in Australia, New Zealand, the UK, everybody's trying to grab more people, right? So the other lever you can try and pull to make your economy bigger is to actually bring more people in. But of course, that actually has its own problems, particularly when you don't have necessarily enough affordable housing and when in fact you're going to be even more congested. But of course, that's the lever that pretty much all governments are now pulling.
Yeah, like a few people have asked me about, your take on this. I mean, like, do you think that, Albo's immigration as seen by, say, Westpac saw 400K net this year, then 350K next year. Do you think that is going to be able to support the housing market?
Well, a lot of the people who come in don't necessarily buy immediately, but they do over the medium term more likely to buy. I'm interested in the New Zealand offer. Come over from New Zealand and you can become a citizen much quicker, right? So that's another. And it's interesting that New Zealand has been one of the most aggressive in terms of trying to recruit people to go to New Zealand in the first place. Yes. So it'll be interesting to watch the balls gyrate. People go to New Zealand. Do they then come back to Australia? I don't know. The problem I've got, though, is that quite a few of the people who will be migrating won't necessarily have the wherewithal to be able to pay the prices that Australians have to buy property. So the immediate pressure will be additional demand in the rental sector, which, of course, as you know and I know, has gone completely pear-shaped. There's about 20% less properties available to rent at the moment compared with 2 or 3 years ago, because property investors are leaving because they can't make it work anymore. So we have a housing crisis already, which is going to be exacerbated by the additional migration. I'm not sure that is going to solve the problem with regard to house prices, and particularly house prices falling, if in fact my thesis is that the long-term damage to households' cash flows ultimately will catch up with them. So, for a period of time, if you've got a deficit, you can mess around with credit cards, or if you've got savings, you can use those first. But if in fact you get to the point where in the second year, the third year, you're still in negative cash flow, you run out of options. And at that point, the only thing you've got to do is either to do equity, mate, if you can do it, although the chances are you've already raided your equity, or indeed, leave and sell at that point. So I still think there are more downward forces in the housing market. Or in other words, migration itself will not be sufficient to support housing very strongly.
Yeah, I think it's an interesting one, because I've spoken to quite a few mortgage brokers, people in, like the people who talk, financial counselors, that sort of thing. And, like what a few have said to me is that people would rather take their chances on staying in their homes, even if they're absolutely underwater, and even if their cash flow is in tatters, because they don't want to have to deal with the rental market. And this was particularly something that I've heard from people in southeastern Queensland. And I think that's an interesting sort of dimension. That's something that I haven't considered previously. Like previously, I looked at the data, like yourself, in terms of how many people who are coming to Australia can actually buy houses. And based on the government's permanent migration intake, I estimated that to be around about sort of like 17,000 a year. And okay, I was like, okay, well, that's that's manageable, that's normal, that's the way things normally are. Now, obviously, that's what the government says is going to happen. Now, what happens in the end with migration numbers is another story entirely. But, in terms of that, based on the permanent migration numbers, but what I didn't consider is the impact that this would have on home listings. And that is the thing that's a real wild card for me in the short term. And I think that's really playing a significant role in supporting housing prices in Sydney in particular, because you are seeing these depressed listing volumes, and you're seeing a larger proportion of desirable stock being taken to auction. And I think that's also distorting the figures somewhat upward, because you are seeing those type of homes coming to market, whereas in the more normal sort of, areas, stock levels and listing levels are a lot more depressed than they are in these more affluent areas that are performing a lot better.
Well, you got to look at the compositional stuff for the way that it's working. I agree with you that those auctions, particularly at the more extended price range, are actually quite buoyant at the moment. But if you look at the first-time buyer segment, for example, completely different story. And if you look at some of the other areas where you would normally expect, considerable listings coming through, they're just not there. So there's a real mismatch. And again, it goes back to what I always say: you've got to look at it granularly. But overall, I think those indices are being distorted because of the distributional issue, and particularly the fact that more affluent people can still buy and sell and are choosing to do so.
Yeah, I think it's just worth noting as well that there are several factors currently supporting the market. There is a global upswing in housing prices across much of the world because reasons. We don't fully understand. US produced a positive number.
Yep.
Sweden, Germany. We've seen quite a few countries, parts of Canada have produced positive numbers, which have, surprised a lot of people. And in a lot of cases, it is that low stock that is, a key part of the story. But I think it's also worth noting that one, seasonality is a factor at this time of year. This is one of the, March, April is generally very, very strong for, March is the strongest month for Australia in general.
Yep.
For housing prices historically. But I think it's also the fact that we are seeing these low stock levels. We are seeing these factors supporting the market, but these factors are not going to last forever. Now, a lot of people, including the major banks, are already flipping at the moment. They've already, you saw ANZ change their forecasts. You're seeing that, all the banks are suddenly, doing the weather vane thing and flipping their forecasts. And I think that's premature. I think that, we've got low stock levels. We've got extremely high levels of immigration. I mean, we've seen 254,000 net arrivals in terms of temporary visa holders between January 1st and March 31st. So in a little over 90 days, we've had to house another 250,000 people, overwhelmingly in Sydney and Melbourne. And then you saw housing prices in Sydney and Melbourne rise during that period. So it's just like, well, I can see a bit of a correlation there, that you are seeing those pressures on the housing sector. But it's also worth noting that while Melbourne had this bit of a burst in February where prices did go higher, they're now moderating and more consistent with seasonality than they are, than where Sydney is performing very, very well. So, I think that it's a complex picture, and I think that it just often gets oversimplified into housing up, housing down. Whereas in actual fact, housing in a lot of places in Australia has actually performed relatively well so far under the, say places like Perth that perform relatively well in the face of higher rates, whereas Sydney has, gone down and then now it's back up a bit. And yeah, it's, as you say, it's all about granular sort of, data.
Yeah, and looking at the regional areas, for example, the regional areas are continuing to fall, and they had a significant run up previously, and now, of course, it's reversing. So again, I think it's a matter of watching and waiting. I think by September, October, we'll get a better read. How much of this is seasonal? How much of it is actually a consequence of higher interest rates? How much of it will be supported by migration? So watch this space. But I'm not of the view that we're at the bottom of house prices. I still think there are more significant factors in the mix here that could definitely drive prices lower. And of course, if we get the recessionary drafts from the US or Europe, which is quite likely, that could have a significant impact as well. So I think anybody who believes the spruikers when they say now's the great time to buy, just remember they don't always get it right.
No, they don't. And I think that it is a really, really just unclear picture at the moment as well. You know, like you've got really low levels of really low transaction volumes. You've got, the fact that borrowing power has collapsed. You've got all these different things, and they're yet to feed through. And I think one of the key things in all this is I fully expect at some point the RBA won't do their job properly. And they'll probably make a mess of things, and they'll probably put downward pressure on the Australian dollar. That's my base case, that they're gonna screw up, which is probably not really a big call, to be completely honest with you. But the thing is, for the moment though, if we are going to see a downward pressure on rates, in the short term, something has to go wrong.
Yeah,
pretty badly wrong, really. To get down from, what is trend mean inflation now, 6.6% back to 3% in a hurry, when you're still seeing inflation running at 1.2, 1.4% a quarter, that's a big ask. And I think people in that regard need to just be a little bit careful what they wish for. They may get the rate cuts that they want, but it may not be under the circumstances that are terribly desirable.
Yeah, you're right. If there was a significant downdraft trigger, then rates could be cut. But the consequences could be significantly worse than people are actually ready for, I think.
Yeah, and I think it's also just worth noting that the economy is already not in a great place if you're just a regular everyday Joe. Per capita terms, the economy went nowhere in Q4. And unless we see a significant acceleration, it's probably going nowhere in Q1 as well. So, it's not really going great, which is ironic in a way, because the US consumer economy is actually performing quite well.
Yeah, that's right. Although the savings ratio continues to drop and the credit continues to rise, which of course is the story, which be interesting how long that can go for. Any other questions before we get into a couple of charts?
Okay, Randy asks, with commercial real estate a potential catastrophe in the major centres of Europe and the US, how will commercial real estate fare in Australia? Also, isn't commercial real estate a big chunk of super funds and a positive yielding portfolio? I'll just quickly take that question. Yes, commercial property is a very significant part of super funds. Property in total, which is generally focused on commercial property, accounts for 16.2% of super balances, according to ASIC. So, yes, it is a very large proportion of it. And I would also add that there are, shall we say, other links between property and super funds, in the sense that some of the financing that's done for some of these big high-rise buildings that are owned by the super funds in the CBD and all across the thing is done by fixed income products to super funds. So it's not just the actual commercial property itself; it's also the bonds and commercial backed securities that they've done to basically deals between various different super funds.
And I'd highlight that in that a lot of it's unlisted, right? So a lot of it is not actually necessarily reflecting current market values. So we don't know what the deficit in terms of value truly is in those unlisted property assets that many super funds hold.
Yeah, I think the thing is that this sector has been allowed to operate in a rather opaque way for a long time.
Surprise, surprise.
And yes, surprise, surprise, this is Australia after all. And I think that things haven't been written down in the past in some areas that have experienced very poor occupancy rates and higher than expected vacancy rates for quite a long time. But I also don't suspect that is going to be righted until they've got a gun to their head and they have to do it because they're forced to by global events. So I don't think that commercial real estate in general is going to be a huge issue in Australia on its own. That's just going to occur organically, mostly because people are going to be more than happy to just temporarily think and just go, it's okay, we're just going to keep with the unlisted book prices. They look great. I don't want to rock the boat. But if we do start to see, some of these financing agreements and some of these commercial mortgage-backed securities start to like really fall over in the rest of the world, which will eventually happen at some point, then I think things get more challenging for the Australian commercial real estate market.
I agree. I don't think the Australian market will lead the problem, but I think we could be inundated by the international downdraft from the commercial property sector. It's pretty bad in the UK. It's pretty bad in the US at the moment. Again, values are overstated significantly. And of course, a lot of that is highly leveraged. One of the factors to bear in mind is that the costs of debt into that sector is rising quite fast because of higher interest rates and because, the funding cycle is putting more pressure on. So the yields that traditionally have been so strong may be quite a lot weaker. And then that starts to beg the question, well, if I'm getting weaker yields, what do I do about it? And at the point when some of those then think about, well, maybe I should dispose of some of those assets, that's the point when the gap between the theoretical on paper value and the true market value could really start to bite.
Yeah, well, I mean, that feeds in nicely to the next question from Dave, who asked about large corporate entities defaulting on commercial real estate loans.
That's right. And they will probably at some point, but not in the short term. But there is definitely upward pressure on the cost of funding. And if you look carefully, even some of the central banks have recently started to recognize this as a potential systemic risk within the financial system. So I think that's a very important observation. But like we said earlier on, this is a slow fuse. This isn't going to sort of blow up tomorrow afternoon. This is going to be quite a few months or maybe 2 or 3 years before it really starts coming through, I think.
Yeah, I agree. Edna asks, are mortgage offset accounts counted as deposits for the purposes of those deposits being insured?
Yeah, so you have the standard answer is there's a standard netting that goes ahead. So if you have assets and liabilities, the bank has the ability to offset and net those, which potentially could be quite interesting. But the insurance deposit scheme at the moment is silent on precisely the way that would work.
Yeah, the APRA, if you ask APRA, they say yes, they are insured. They will tell you yes, they're insured. They're insured up to $250,000, just like any other account. But as you say, how that works in practice, should things really, I mean, realistically, I think that they'd probably be okay. But if things really went pear-shaped, particularly for some of these smaller lenders, things get murky.
Look, the chances are we will see some smaller lenders get into difficulty in Australia over the next couple of years, but the workout plan will be that they will be absorbed by the bigger players, which is what happened last time in 2008. I think it's highly unlikely that we would see a small organization completely collapse. The other point, of course, is that the assets that they hold are valuable and they could be on-sold in any case. So it's a much more complicated picture than people would like to see. Definitively, we know that there's a theoretical $250,000 per relationship per brand. So if you have St. George and Westpac, it's aggregate across those two. But of course, the other point is that there's only actually a 20 billion theoretical allowance per institution, right? Well, if you look at the total amount of deposits that are actually in Australia, it's way more than the 20 billion that is there. So they would have to do something else as well if, in fact, it started to go wrong. But again, there's silence on all these critical issues. Nobody wants to discuss how this might play out. Nobody wants to actually scare the horses.
No one wants to rock the boat.
Yep.
Okay, and this is our last question from the day from Jude. The input formula for Aussie housing seems unlikely to change. Credit will be expanded, we'll see longer mortgages, APRA loosened serviceability requirements, continued NIMBYs, mega migration. If these factors were to continue, what are the likely impacts on society?
That is the mega question, right? I mean, we've got to the point now where housing and housing finance is effectively the black hole that's sucking everything into it. So as a result of that, less and less activity, if you look at from a business perspective, is happening. There's less manufacturing. More people are actually directly or indirectly connected with the housing and construction sector. So we've got ourselves this black hole problem where everything is being absorbed and it's getting bigger and bigger and taking over more and more of the economy. That's not good for society. That's not good from a point of view of a productive economy, because of course it's just amplifying what's currently there. Theoretically, lifting house prices means that banks can lend more, which means that they can expand their balance sheet, which means they can lend more, which can actually drive house prices higher. But it also excludes more and more people from being able to buy property. And that's why there's a real problem with housing accessibility, housing affordability. That puts pressure on households, particularly younger households. That puts more pressure then on the rental sector. That stops people being mobile. That stops people perhaps doing the things they'd want to do. So the consequences of this bad policy over the last 20 to 30 years in terms of the nature of the society are profound and disgraceful. And yet neither government nor indeed central bank want to take accountability for it. So I'm afraid it's a big problem and it's taking society the wrong way.
Yeah, I mean, I concur. I think that the part of the problem with all of this is that it's the impact of the housing bubble, of high household debt, of all these different things is really painfully oversimplified.
Yep.
Because what I feel like it comes down to is the RBA comes up with a paper and they say, okay, if household wealth increases by X, then consumption of households will increase by Y. And that's basically the way the economy runs. Now, you feed equity mate and other sort of things into that, but that's basically the core, sort of driver, shall we say, of the economy at this point. Excluding, say, for example, the mining and the resources sector more broadly. And the problem is that, as we discussed earlier in the show, the traditional way an economy functions, in the sense that people see rising real incomes, rising real consumption, economic growth, sort of virtuous cycle, that's gone. That exists to a degree for older demographics, but for younger demographics, that's basically dead and buried. Like for consumption for people aged 20 to 24 peaked in real terms in 2009. For people aged up to 34, between 25 and 34, consumption peaked in 2008. So we haven't had what you would consider, what the rest of the world would consider, a normal consumer economy for basically the better part of almost 15 years now. And I think that the problem is that rather than this prompting some soul searching and some very, sort of intense head scratching as to how we were going to solve this problem and, get the economy on a more even keel, better growth, better quality growth, instead, what I feel like we've done is we've doubled down and we've doubled down again. And then the APRA's turned around and gone, no, you can borrow even more. And we've just doubled down again and again, to the point where it's the only game in town. There is no alternative anymore. And that's something that's a realization that I've really just come to recently, just in the sense that they don't have, this isn't, people say to me, oh, it's about boomers. It's about, it's about politics. And I think we can see now that, I don't want to say the boomer vote doesn't matter, but the boomer vote all flowing to Dutton doesn't really matter, because you've got to win the rest of the vote in order for it, in order to form a government. But I feel like what the problem is that boomers are the engine. Boomers and older Gen Xers are the engine of consumption in this country now. They are the ones who are seeing their consumption levels rise very, very strongly above where they were in 2008. Whereas people under the age of say 45, or maybe even 50 now, because this data is 5 years old, are basically seeing their consumption either flat, rising very strong, very, very, very moderately in some cases, but overwhelmingly it's being driven by people aged over 45. So it's the boomer Gen X demographics who are powering the economy now. So it's not the fact that they have the political power, it's the fact that they are the only organic driver of the economy left, if you can call equity mate and the wealth effect organic.
Well, but that's the point, and this is why I've come back on several occasions to highlight the contention between the generations, right? Because essentially there's a set of economic assumptions that politicians and the central banks are making about the way things work, which doesn't actually reflect accurately the bulk now of voters. So at some point, it's going to come unglued. It's a question of how it comes unglued, unless they can extend credit to the point where more people can afford then to go and get bigger mortgages to be able to get houses, or the government gives money directly to people to, unless you can convert them into homeowners. This is going to come unglued at some point, because it's not a sustainable strategy. It's not actually one that protects the economy into the future, nor indeed individuals nor businesses into the future. It's a very tactical, it's a very same old, we'll keep on doing what we did previously and hope we get the same result rather than a different result. But the fact is that the results are not actually necessarily positive for broader Australia. And I do think that the political fallout from this could be quite significant later, but it will take a bit of time to play out, because at the moment, both sides of politics actually are stacked up in the same place. Unless you listen to something like the Greens, for example, who do have different policies. Most of the mainstream politicians are all corralled around banks, property, those sorts of things. But maybe that will change.
Yeah, well, hopefully it will change, but we'll have to see.
It needs to change. But
indeed, I'm just going to share my screen now for the slides.
Okay. It's a very good slide.
Yeah, all about that soft landing, mate. All right, now this one is of the RBA cash rate minus the US federal funds rate. And this is something, this goes back to Liam's question earlier. And we are already at the equal largest level of the gap between the RBA rate being lower than the Fed rate, which is not something that has historically happened in the past. So if the RBA does blink and doesn't raise rates next week, well, we're going to have another new record, and that's going to be something that is going to put, potentially some fairly significant downward pressures on the Australian dollar.
Yeah, well, the pound Aussie dollars dropped. It's 53, which is not good. I was hoping it's going the other way, but we'll see about that. But no, this is a big problem. It means that to an extent that the RBA can decouple from the Fed, there's a consequence.
Indeed, and I think it's just worth noting that this is what things look like when we have a war and a bunch of other things propping up our commodity prices, the prices of our commodities.
Yeah,
if we didn't have the war in Ukraine propping up things, and we had a smaller trade surplus, or perhaps even a trade deficit, the Australian dollar would look quite different to where it is today.
Yep.
Okay, now New Zealand housing prices, because I know some of our Kiwi viewers quite enjoy this one. Basically, the housing crash has resumed. We saw a little bit of an uptick in February because seasonality happens every year. Yep. A lot of people running around with their heads with their hair on fire, telling people otherwise. But yes, housing prices have resumed, and if some of our eagle-eyed viewers may notice here as well that at this point in the cycle, US housing prices actually ticked up as well.
Yep.
Where quite a few people in the US were then running around Miami in their convertibles, telling everyone that everything was going to be fine. And well, people can watch Steve Carell and Christian Bale in The Big Short and find out how that particular little jaunt ended for them. All right, so but. I think this is just an interesting one as well, because you have the issue of how, this divergence between Australia and New Zealand. You're seeing their housing prices continuing to fall while ours sort of, shall we say, basically tread water, or in Sydney's case, rise relatively decently. And I think it's going to be interesting to see.
Yeah, two points. One, of course, is that the New Zealand cash rate's higher, so they've actually been more aggressive in their tightening cycle. And the other is that the migration profile, Australia and New Zealand is different. Those two factors probably are playing into it a little bit.
Oh, 100%. And I that's I was just going to add that one of the things that I think is going to be interesting is that New Zealand are now trying to ramp immigration aggressively.
Yep.
And New Zealand saw the largest seasonal increase in temporary visa holders ever
Yep.
in March. So they are, and not only that, also the RBNZ has also, because the RBN, for those who don't know, the RBNZ basically acts as the banking regulator as well as the macroprudential regulator, I should say, as well as their role as a central bank. So that they are also removing some of the various restrictions on the number of loans that can be written at an LVR of higher than 80. So that's also going to be something that's going to potentially, be a factor to support the Kiwi housing market. But it's going to be interesting to see as the Kiwi government and the RBNZ try to support their housing market, exactly how successful they'll be, considering the backdrop is pretty challenging. And Wellington is only a hair's breadth away from US housing crash levels of price drops.
Yep. Wellington, I've been watching, it's pretty painful.
All right, now this is the chart on real household consumption that I was talking about before. And it basically shows that for, as I was saying, that for people aged between 15 and 34, their consumption peaked quite a while ago. And for the older demographics, their consumption continues to rise. So it just goes to show that this idea that young people are all frivolous and they're spending more than ever, and they can't defer gratification and blah 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 blah, isn't supported by the data. In fact, it's the boomers and Gen X, and maybe perhaps to a degree some of the very, very eldest millennials. Actually, no, that's not correct. Actually, it is boomers and Gen X, by going by this data, who are the people who are powering the economy with additional levels of consumption. So I think it's going to be a really interesting one going forward, because something's got to give, especially because people are taking on these larger and larger mortgages, which means there's less there's less there for these people to consume. And there's also, as you previously mentioned, Martin, the fact that there's less because everything costs more. And this particular chart is in inflation adjusted terms. It's not in just pure nominal dollars.
Yeah, and it's worth highlighting that it's deflated with the aggregate household consumption deflator. Now, that may or may not be an issue, insofar that, of course, the consumption deflator will be different by the different age groups. I don't know whether they did it at an age group level or whether it was actually the aggregate that they used, because that would actually distort the numbers.
That's a good point. I'll have to look into that. All right, on to the next one. Now, this is an analysis I did based on some of the data from the Productivity Commission on how wages have grown in real terms for various different age demographics, and it's not incorrect. The black and the yellow line on the left-hand chart, that is actually what the path of real wages growth has looked like on an average basis for these demographics. And on the right there, just for a bit of perspective, I put the average rate of annual real wage growth for Japan during its lost decade, which was from 1991 till 2001. So for Australians under the age of 34 in 2018, they've had a worse decade than the Japanese did during their lost decade. So I think this idea that Gen Y are a bunch of whingers and Gen Z are a bunch of whingers, and that things are actually really fantastic and that they should just shut up, is basically bull. And they've actually been dealt a really, really raw deal. That's what the data says.
I agree. I see it in my surveys too. And the point there is that this is such a long-term trend now that it's very hard for those particular households to ever recover as they move up through the generations, because they didn't have the wealth kicker that the older people had when they were younger.
That's an interesting point, because as you've shared with me previously, your data from which you've got back to, I think it's about 2002 or 2004, of when people buy their first home has just gotten later and later and later and later.
Yep.
So they haven't had that same chance to build wealth. They haven't had that same chance to, perhaps build a business using equity or whatever it is. So, I mean, I really do wonder, that would be a fantastic case study over time as to just to see how different households have fared who did have a leg up and those who didn't. Just as to how their sort of financial circumstances have evolved over time. Because, I mean, it's pretty hard to get ahead when you're going nowhere in real terms.
And bear in mind, HEX, of course, is a much bigger factor now than it used to be.
True.
And only the only people who are getting a little bit of a leg up are the bank, people who can access the bank of mum and dad. So if you actually are in the situation where your parents have equity that they can share with you, that's about the only way you can get ahead at the moment. It's diabolical what's happened.
Yeah, it's kind of like I was at a barbecue a few weeks ago, well, probably more like a few months ago now, actually, but it was at a family friend's house. And this house is, don't get me wrong, it's a nice place, near the beach in Sydney. It's worth probably the best part of 3 or 4 million. I don't know exactly how much. I didn't look, but it wouldn't. But it was worth a lot, and it was owned by a cleaner and a receptionist. Now, I know some other people who live just down the road from there. One of them is a sort of fairly senior white collar worker in the sort of 150, 180K a year. Another one is a physio who is well over $100,000 a year, and they're struggling to get a 2-bedroom apartment. And I just think that is just poetic. That, and I'm not saying that there's anything wrong with being a cleaner or a receptionist. I was a cleaner for years. I used to, for those of you who may not know, I used to mop up kiddies' spew at night for a living. While I was at uni, and I think it's interesting that, 2 nurses or 2 coppers or 2 teachers can't buy something even relatively basic in parts of the country now that is closest to their place of business, where, well, we need them to be, because you need a copper to be a copper, and you need a nurse to be a nurse. And I just think it's interesting that, there's just, I think it comes back to, this is something that you and I have discussed before, but I think it comes back to who should be able to afford a house, who should be able to afford to live. I mean, there was that article in The Guardian the other day that said that only 1% of rental properties nationally are affordable on a single minimum wage. And for better or worse, people on the minimum wage exist. People on the minimum wage, people have life circumstances that complicate things. People, quit work and they care for sick relatives, or they do any number of things, or for a sick child or whatever, and then they have to go back to work, and maybe they can't go back to the same level of income they had before, and they just take what they can get. And I think that there needs to be a place for those people in our society that isn't the scrap heap.
Well, the point is, Tarric, 2 points. The first is that if you actually understand neoliberalism and the way it works, then effectively it's all down to the market and market forces, and those who can afford it find those who can't. That's a problem. The other is that I believe that housing, and good quality housing, should be a human right, not just a market force driven outcome for a certain proportion of the population. But that's a very important and different way of thinking than neoliberalism. But neoliberalism is the way that the central bank and also politics in Australia works at the moment, which is why we've got this huge diversity of outcome between those who have and those who haven't, and it's getting worse rather than better.
Yeah, it kind of astounds me. I'm going to be careful here, just not to say something that's going to get me into trouble, but it's just I find it a little bit mind-boggling that we have this rental crisis, and admittedly, its genesis was in the pandemic. It was, working from home. It was changing household sizes. It was more people wanting to get out of, being stuck with mum and dad or roommates in lockdown, etc. But at the end of the day, it's not a politician's job to prosecute an agenda based on ideology. It's a politician's job to prosecute an agenda. Okay, it can be influenced by ideology, but it also needs to be informed by reality. And I don't think that the current approach to just, hey, here's 400,000 migrants is the right way to go about things. There needs to be some consideration of, the tent cities popping up, and the rising levels of crime, and all the other socioeconomic issues that come with this. And I think that's something that Edwin has covered recently on Twitter. I'm not sure if he's discussed it with you, Martin, but
Yep.
you are seeing this sort of deterioration of elements of society, and that's not what we want to see. I mean, I said to people the other day that at the society, we rise and fall together. I could win the lotto tomorrow, or I could get a really amazing job and earn squillions and be able to provide a great life for my children and my grandchildren. But what exactly is the point if society falls apart along that particular journey? I don't see the point. We need to have some sort of collective objective of what is acceptable and what isn't. But I've been contacted by quite a few people who've shared these particular concerns with their members of parliament. People who are, people whose local member is a Liberal or a Labor member, and they've basically just got cookie cutter responses, which is sad, because these are the people who make decisions for our country.
Well, of course, Maggie Thatcher was famous for saying society doesn't exist, it's down to the individual, right? And if you put in the individual as the only element that's important here, and if you actually then overlay neoliberal over the top, that's what you get. But there's a very important societal question here, because you're right, you need a functioning society, a society that can actually work for the mutual good. And I think that the main problem we have at the moment is that the definition of good outcomes from a political perspective are actually measured just in economic terms and GDP terms, rather than actually some of these broader questions, which is about how you make society better. That, for me, is the critical question. And, every time you look at all these statistics, you realize that things continue to go in the wrong direction. And that means that we're going to get more breaks in society, more of a fractured society, and ultimately things could fall apart. So it's about time politicians woke up and realized that their own future is actually going to be determined not by just the narrow path that they've been treading for the last 20, 30 years. Yeah,
I feel sort of, like that they always say, to fear the wrath of a quiet man. It's all, that it's always the person who puts up with the most, who responds to, unnecessary hardship and chagrin and whatever else is directed at them with, relative apathy and, just acceptance. Like I've lived other places in the world, and people, if you screw something up in government, you end up with people out on the street with Molotov cocktails, which isn't necessarily a bad thing as long as they keep it, relatively peaceful. I mean, like say in France, for example. But I do wonder sometimes, Australians are probably the most apathetic people on the face of the planet. We put up with a lot, but I do wonder if you just push them too far, exactly where that breaking point will be, and exactly what we'll do to bite back. Because a lot of people are missing out, and a lot of people are being shafted. And I mean, and I'm not even sort of talking about that in the sort of more abstract way of even things like housing and stuff like that, which some people might see as a sort of subjective issue, but I just even mean in terms of putting food on the table and of your wages keeping up with your costs.
Yeah, no, it's a very critical issue, Tarric, and one I'm sure we'll come back to. Wonderful. Well, Tarric, it's been great to catch up with you again and to reinstate our fortnightly reviews of the week. We'll try and do it every other week if you're okay with that. And thanks for doing it at 6 p.m. your time, which means it'll be released slightly later, but hopefully not too much later. Always plenty to explore. And once I get my full studio here, I'll be able to do the full switching and other things. But at the moment, we'll be running off the smoke and oily rag, but at least we can still do it.
Yeah, no worries, mate. I'm really pleased to be here, and I'll be here this time in a fortnight.
I look forward to it. Have a great weekend, and I'm sure there'll be plenty more to talk about. Not least, of course, there'll be more central bank decisions, and lots of other great things going on. And the old house price shenanigans will also be continuing.
Well, we'll have the full month's data for next time and all the listing data. So I'm sure we'll do a little bit of a deep dive into that when it comes.
Look forward to that. Thank you very much, Tarric, and take care. See you soon.
Catch you later, mate. Bye.
Cheers. Bye-bye.